Is investing in the stock market just gambling? I think a lot of people are afraid to get started investing because they think that the market just looks something like this, where it just shoots up and down all the time and it starts and ends kind of in the same place. And it's just a roller coaster and it's just pure luck whether you get on at the right time or the wrong time. And they're afraid of buying up here and losing all their money. And they think that the people who got rich are just people who got lucky enough to buy here and make a bunch of money. But this is not accurate. This is not what the stock market looks like. I'll fix it for you. There. This is what the stock market is. So yes, it does shoot up and down. It's volatile, right? But it's not flat like this. It has an upward bias. So it doesn't matter where on the short-term cycle you are. As long as you buy, you are getting on this escalator that slowly moves upward over time. Let me show you with a real stock market chart. So we're looking at the S&P 500. I'm going to move myself. I'm in the way a little bit. I'm going to go up here. Okay, hi. So we're looking at the S&P 500, and this is over just the last 3 trading days. And if you look at just that time frame, it does look pretty wild, right? Like you start here, it drops, it shoots way up, it drops way down. The next day it opens up higher, and it just kind of looks like this all over the place seesaw, right? But that is short-term information. And I think it's really beneficial to look at the stock market with a long time perspective, because I think good investing is long-term investing. So let's take a look at that. Let's look at a longer time frame. Here we have a time period starting around 1985, and we can draw a line up to where the market is today. And you can see there are market crashes. Here is the 2000 tech bubble. Here's 2008. And you can see that those do have impacts on the market. And if you invested all of your money right here at the peak, it would have taken you a long time to break even and get your money back. That is a real part of investing. But the important thing is to look at those long-term trends. It has an upward bias. That tells you something about what the market is and what it does. Because remember, when you're buying something like the S&P 500, you're buying 500 of the largest companies in the United States. And so I think in a lot of ways, that sort of broad representation of the market represents something about humanity, about our ingenuity and our desire to keep growing and inventing new things and pushing the boundaries, right? A lot of that growth that you see in the chart is invention of new things. Like back in 1985, I don't think anybody could have predicted what the internet was going to do to our society and our economy. It would be hard to even imagine that some of the biggest companies that we have today are social media sites or video streaming platforms, right? Like Netflix. That didn't exist back then. So the market isn't just a wild ride for no reason. You're attaching yourself to the growth of human civilization, essentially. And over time, that pays off. People focus way too much on the short-term movement, the little swings in the market. I think it's important to realize that that is normal. That is going to happen every day, every year. There are going to be ups and downs. But try to think of it less like you're trying to jump on and off of a moving roller coaster and trying to time it right, because the timing doesn't actually matter as much as you think. Think of it more like you're planting seeds, like you're planting an orchard. You know that it's going to take 30 years before that orchard matures and starts producing the fruit that you need. But you're okay because you know once you get to that point, you're going to be set. It's going to work out for you. You don't need to worry about the day-to-day growth of each individual tree and whether it's going through a drought or a rainy season. Those things don't matter. You just look at it as you're planting these seeds. You know that in the long term, they'll pay off for you and you'll have an orchard. But I do want to circle back. I started with the question, is investing gambling? And I think the answer is no, not really, depending on how you do it. I think it's important to remember that the market isn't all one thing. It's like, imagine you're going to a playground, right? Some people might go there because they want to swing on the swings. Some people might want to hang on the monkey bars. Some people might want to go down the slides. It's one place, but people might go there for different reasons. And the stock market is the same thing. So the stock market itself is just a place where people go to buy and sell stocks. But people go there for different reasons. So there are people like me who go there to buy diversified index funds where you're buying thousands of companies all at once so that I can hold them for decades. That's called being a buy and hold investor. But there are other people there who are doing different things. Some people go there because they want to try to pick individual stocks that they think will be the next big thing and outperform the market. And I think that is a form of gambling. You're placing a bet that you think you know which stocks are going to win in the future. And anytime you're predicting the future like that, it's always a bit of a gamble, right? And there are people who try to gamble based on timing. Like, they'll look at a daily price movement like this. They might see a stock drop like this at the start of the day and think, well, if I buy it while it's down here, then I'll be able to profit from when it goes back up, right? But once again, that means that they are placing bets based on guesses about what's going to happen in the future. All we know looking at a chart like that is what has happened recently, right? And so trying to look at a chart like that and say, oh, based on that, I think I know what's going to happen next is making a guess. And so I think that is a form of gambling. People will do this with their whole portfolios too. When there's a big market crash, like when COVID happened, a lot of people will go in and try to sell their whole portfolio and move to cash because they want to try to be safe, right? But the problem with that sort of thing is that you have to be right twice. You have to know when to get out of the market and the right time to get back into the market. And I've seen over and over again, people can't do that consistently because what they end up doing is selling when things are scary, which means that the crash has already started. And then they don't want to buy back in until things don't feel scary anymore. And that's almost always long after the recovery has already started, right? So they end up selling after the crash and buying back in after the recovery, which is the opposite of what you want to do. But once again, that type of thing, selling your portfolio and moving to cash is also a form of gambling because once again, you're trying to make predictions about what the market is going to do and you're trying to profit based on those predictions, right? And here's the deal. I think to be successful as an investor, we need to set up systems because I think, most people think that the biggest risk to their financial situation is this kind of volatility, right? They think that the ups and downs are going to hurt them. That's not actually the case. The most dangerous thing to your financial situation is actually you. It's your behavior and your fears and your emotions. It's things like overconfidence and greed or fear and panic that cause you to either make concentrated bets on things that you shouldn't be because you have that overconfidence, or that cause you to panic sell when the market starts to go down because you have that fear. And I think to be successful, the best way to do it is to set up systems that help remove the decision-making from the process as much as possible. Every time you're trying to make a decision, every time you're trying to say, oh, maybe I should invest in this investment instead of this one, or maybe I should buy or sell. Every time you have a decision like that, it introduces the potential for you to make a mistake. I think a better approach is to have a system that removes that potential for mistakes, for human error, as much as possible. Now, what do I mean by that? It's actually pretty simple. So I think there are kind of two broad mistakes that I think a lot of people make. One is making concentrated bets, trying to pick individual stocks or trying to pick individual sectors of the market. So things like saying, oh, I think that this specific company is going to outperform the rest of the market, so I'm going to put all my money into that company. That introduces a lot more risk because even if that company does well, you don't know that it's going to be the best performing company. You don't know it's going to do better than the market overall. But you're also introducing a ton of volatility and potential for losing everything if that company were to go bankrupt. But it doesn't even have to be just trying to pick individual companies. There are people who will bet on specific sectors. Like they say, oh, I want to buy all the AI stocks or all the tech stocks because they've done well recently. So why wouldn't that continue? Well, there could be a lot of reasons that wouldn't continue. And so maybe instead of trying to place bets on specific sectors and making guesses about what you think will win, why not just buy the whole market? So that's the first potential for gambling, is trying to pick winners in advance, whether it's individual stocks or sectors, and making bets on those specific winners. But once again, like I said, nobody knows the future. And whenever you do that, you're increasing the potential for human error. So what do I do instead? I buy index funds for a couple of reasons. So index funds are collections of stocks that kind of represent the whole market. So you can buy like an S&P 500 index fund that just buys the 500 largest companies in the United States. You can buy a total stock market index fund, which represents all of the publicly traded companies in the United States. Or there are international index funds or total world index funds that represent the entire stock market all across the world. We'll talk more about how to select specific funds in the future. But the point is that by buying that one fund, you're buying a representation of the entire market. And there are a couple of benefits to this. I've already made one video about how it makes it so that you don't have company-specific risk or industry-specific risk. So it helps reduce that overall risk of your portfolio. But it also ensures that you own the winners. You reduce that risk of missing out. I don't think most of us think of owning a business in the same sort of category as just going to a casino and putting your money on the roulette table, right? But there are still risks. It's possible for businesses to go bankrupt and lose money. So anytime you're picking individual stocks, you're increasing that risk that one of those companies you own will go bankrupt and it'll have a big impact on your finances. But if owning one stock is risky, owning 1,000 stocks, it's a lot less risky. Obviously, from stock market history, you'll see that there's a lot of volatility. There are still market crashes and downturns, and that's just normal. You're going to have to get used to that. But your risk of losing all of your money is not the same. When you own one company, it is absolutely possible for that company to go bankrupt and for you to lose everything. But if you own 1,000 companies, I mean, think about what would it take for all of those companies to go bankrupt all at the same time? It would have to be like a zombie apocalypse. Not saying that could never happen, but man, that would be rare. And if that happens, none of this stuff matters anyway. So buying a diversified portfolio, buying an index fund where you're buying all of these companies at the same time is a great way to reduce the risk and move away from pure gambling to investing. I think it was Jack Bogle that said that instead of trying to look for the needle in the haystack, it's better to just buy the whole haystack. And that's kind of the approach you take when you buy an index fund. But it also goes deeper than that. Index funds are self-cleansing, meaning that if a company goes bankrupt, it just loses its value and falls off the index and gets replaced by something else over time. So it makes it so that you never have to make that decision again about what stock to buy or what stock to sell. You don't have to watch and see, oh, Blockbuster Video used to be a good company, but is it going to be in the future? You never have to worry about that because the index fund will take care of that for you because it's self-cleansing. So buying an index fund reduces that risk of human error when it comes to which stocks you should own. But what about the risk of market timing? Like I said, there are people who actively buy and sell, and each one of those decisions introduces that risk of human error. Well, I think there are two ways to avoid that risk. One is to commit to being a long-term buy and hold investor. To know deep down that market ups and downs are going to happen, they are impossible to time consistently, and that the best thing you can do is just wait through them. The second thing you can do is to consistently keep buying your index funds. So this happens automatically for people who are investing in like a 401k, where every paycheck they receive, part of it goes to their investments. But if you're investing outside of a 401k, if you're doing it on your own in an IRA or a brokerage account, you can set up the same sort of system. The fancy finance word for this is dollar cost averaging. And there's a certain benefit to this because if you're just buying a certain dollar amount on a regular schedule, like every 2 weeks, like let's say that you're putting in $200 every 2 weeks into a total stock market index fund. What that means is that when the market is high, those dollars will buy fewer shares. And when the market drops, that same amount of dollars will buy more shares. So it sets up a system where automatically you're buying more shares when the prices are lower and fewer shares when the prices are higher. This creates, once again, a rules-based system where you benefit from market drops. You don't need to worry about being right about what the market is going to do in the future. It removes that kind of human error from it and makes it so that you automatically just benefit from the market swings. The great news about this is that by setting up a system like this, where you're buying index funds on a regular schedule and dollar cost averaging, yes, it removes that risk of human error, but it also has another benefit, which is that it's really simple to implement. You just have a couple of index funds that make up your portfolio, and then you just set up recurring purchases into them, and then just hold them forever or until you need to start making withdrawals in retirement. It's so simple to implement. And I think that's just really lucky that the easiest and simplest plan to implement is also the one that is the most robust and works the most reliably. You don't have to be a big finance guru and know how to analyze individual stocks to be able to build a plan that will actually build you the future that you need. So we'll have some videos in the near future talking about how to select those individual index funds that you need and how to get this plan all set up. But I hope you can see a couple of things from this video. One, just that investing in the stock market is not gambling. It's hitching yourself to the engine of human ingenuity and letting the growth of all of our businesses benefit you, right? Benefiting from all of their profit and innovation. But I hope it also showed you some of that behavioral risk of trying to pick the winners or trying to time the market. Anytime you're trying to make guesses about what the future is going to hold, I'm hoping that you pause and think, maybe I shouldn't do that. Maybe there's a better way to have more of a rules-based approach that will help protect me from making the wrong decision. Anytime you're trying to pick individual stocks or trying to predict who the winner is going to be, that's probably going to be gambling. Anytime you're trying to predict short-term price movements, that's definitely gambling. But if you are planting seeds in a diversified portfolio that you're going to let grow for 30 years, that's as close to investing as you can get, where you're trying to remove human error and you're trying to reduce as many risks as you possibly can. That kind of activity has a much more reliable long-term expectation of giving you a positive return. It doesn't rely on you being right about some prediction in the future. It just relies on human ingenuity continuing to happen, which I think is a pretty safe bet. If this helps, please consider subscribing. I'm going to keep posting videos about this stuff and trying to release content that is helpful for you. So I hope you stick around for those future videos. But if you do have any specific money questions that I'm not answering, please check out the email address in the video description and send me an email directly there. I'm always happy to hear from you. And in the meantime, thanks for watching, and I hope you have a great day.